The yield curve in the United States has now been inverted for around 530 days. Between 2006 and 2007, the yield curve was also inverted for around 530 days. Throughout history, going back to the 1920s, the yield curve has inverted for various periods of time, all of them eventually leading to recession at one point or another. But today, it seems things are different. We've gotten used to the yield curve being inverted now for the last year and a half. The economy has been doing well, the stock market has been making new all-time highs, the unemployment rate has stayed low, and so this is leading many people to conclude that the yield curve being inverted for so long with nothing bad happening in the economy means that we are out of the woods. But it could be just the opposite. In February of 1928, the yield curve inverted and stayed inverted for over 600 days. During that period, the economy was booming, the stock market was making new all-time highs, and the unemployment rate was low. Following that 600-day yield curve inversion, the U.S. economy experienced one of the most prolonged and difficult economic downturns in modern financial history. Now, of course, the U.S. economy is very different today in 2024 to what it was like in 1929. But if we look at what happened in 2006, the yield curve stayed inverted for around 530 days, and throughout this period, the economy was doing well, the stock market was making new highs, and the unemployment rate was low. But this prolonged yield curve inversion was also then followed by one of the largest economic downturns since the Great Depression, with the stock market dropping by a staggering 60%. On the other hand, if we rewind to the 1989 yield curve inversion, that was a much shorter inversion. In total, the yield curve was only inverted for around 175 days, which is actually one of the shortest periods of time in history where the yield curve was inverted. And although that did also eventually lead to a recession in 1990, this was one of the shallowest downturns we've seen in modern financial history. So at a first glance, it does seem that the longer the yield curve stays inverted, the more serious the economic downturn that follows. And when the yield curve is inverted for less time, it leads to less serious economic downturns and shallower bear markets. The theory being that when the yield curve is inverted, it doesn't necessarily trigger an economic downturn straight away, but it gradually weakens the economy, and the longer it stays inverted, the more vulnerable the economy becomes to some kind of an external shock that can trigger a recession. In many cases throughout history, that shock comes from oil. That was actually the case in 2007, where oil prices spiked, and that triggered a recession. It happened in 2001, where oil prices spiked, and that triggered a recession. It also triggered the recession in 1989, in the 1980s, and in the 1970s. All of these oil shocks were followed by recessions. The only recession that wasn't triggered by an oil shock was actually in 2020 that was triggered by the pandemic. Now, another type of shock that can trigger a recession could be a market crash, like the Black Tuesday crash that occurred in 1929, that many people believe was the initial catalyst for the Great Depression that followed. In 1987, we saw a similar flash crash. Many people thought the price action on the stock market looked very similar to what happened in the Great Depression, where a euphoric melt-up eventually led to a 30% drop in the market. But the crash in 1987 never led to a Great Depression like in the 1930s. The big difference, of course, is that the yield curve had never been inverted in 1987, whereas it had been inverted for over 600 days when the crash occurred in 1929. Fast forward to today's market melt-up. If stocks also head into a blow-off top today, similar to 1987 and 1929, which we've already shown is what seems to be happening today, it could be concerning given that the yield curve has been inverted for the same amount of time as it was before 2008. So is there any truth to this theory? You can see here I've labeled the number of days where the yield curve was inverted for every single episode in history, the worst ones being in 1929, 2008, in 1974, all of them with the yield curve inverted for over 500 days, and the shortest yield curve inversions being 1966, 2020, and 1989, where the yield curve stayed inverted for less than 200 days. In all of these cases, these episodes happen to have been followed by the shallowest and shortest bear markets in history. When we plot this on a graph of the number of inverted days against the drawdowns that the stock market experienced following each inversion, we do see that there is a correlation between the number of days where the yield curve was inverted with the stock market drawdown. This is the 1929 episode, this is the 2008 episode, 1974. This is 1969, 1989, and 2020 right here. Now, of course, there are only 8 episodes to look at, and that is not enough data to really have 100% confidence in any type of trend. The yield curve today has been inverted for 540 days, which puts us right around the 1974 and 2008 episodes. This is one of the key reasons why we are expecting the next bear market to be quite severe. Now, that's just our way of looking at how the yield curve is going to impact the stock market in the future. But in the here and now, how high can the stock market go while the yield curve stays inverted? In 2019, for example, the yield curve inverted in June, and the stock market continued to rise another 25% for 258 days before the big peak that was made in February of 2020. In July of 2006, the yield curve inverted, and the stock market also rose another 25%, this time for over 600 days before the stock market peaked in October of 2007. Rewind to 1989 and the stock market rose 29% following the yield curve inversion for 500 days. The most exceptional example is actually January of 1928, where the yield curve inverted and the stock market continued to rally 98% until August of 1929. So the stock market almost doubled in price over the course of 2 years before finally making its peak. All of these episodes show us that the stock market rally can continue despite the yield curve being an ominous signal for investors. In terms of how long that can go, the maximum amount of time that we've seen the stock market rally after an inversion was in 2007 for 657 days. If the market were to also rally for 657 days following the 2022 yield curve inversion, that would mean there's another 146 days left, which would take us to August of 2024. Although we think there's the possibility of short-term downside, this is a scenario that we think is quite plausible. Now, it could be that we are dead wrong about a big correction coming following the yield curve inversion, or dead wrong about the fact that a final rally is coming before that happens. We thought recession risks were quite elevated in February of 2023. We closed our long bets on consumer discretionary and tech stocks that are now up around 45% since we closed those positions. Now, we've had quite a few successful trades as well. We made a few crypto bets that went up by around 100%. We've been holding precious metals and gold miners that have performed incredibly well over the last year. If you want to take a look at our trades, go to gameoftrades.net and you can test our service out completely for free.